Hello, my name is Neil Kane. I'm a financial advisor with Capital Financial Planners. Today, I'm going to be walking you through one of your predominantly most used fund in the TSP, which is your C Fund. The C Fund is represented by the S&P 500 index, market cap weighted. A lot of people have a distorted reality on really what their C fund is comprised of. They understand that there's household names like Apple, Microsoft, Berkshire, Amazon that consist of this index. But the hidden reality is that the smaller, more less prominent names in this index are really unrepresented. And the reason for that is the larger the company trades at in terms of valuation, which means the price per share actually creates a larger valuation, the more the weight that that company gets in the index that is being represented by the S&P 500 C fund. So today we see the largest concentration risk that we've ever seen in this index. We've seen 39% of the TSP C fund, the S&P 500 represented by just 10 companies. All right. We haven't seen that type of concentration risk really ever. Even if we look back to the dot-com era where we saw arguably one of our largest concentration of 25%, that is really overshadowed by what's going on today. That's also overshadowing the other 490 companies that are meant to diversify that index, which brings you to about 1/3 of your risk in your TSPC fund to just a small amount of names. The thought process behind this is, well, what is an alternative? Well, first, we have to kind of take a look at what we mean by market cap weighting. Market cap weighting essentially takes the company's valuation based on price per share and gives that a larger percentage in the index. That's essentially what the C fund does. It creates larger companies like Apple get a much larger percentage of the index, and companies that are small get a much smaller percentage of the index. So the size of the company based on valuation gets a larger percentage in that index. The alternative approach to that is what's called equal weighting. So, in that approach, imagine 500 companies, okay, 500, and now we're going to give equal representation to the index on all 500 companies, meaning that we're not going to skew some of these high valued companies like Apple to get a larger proportion of the index than some of these smaller companies. In that case, we have a more diversified S&P 500 index under what we call equal weighting. All right. If we look back throughout history, we'll actually see the dynamic between market cap, which is your C fund, and equal weighting play out. We'll notice that in the first half of this 3-decade period that we're analyzing, equal weighting actually played out better. Equal weighting outperformed market cap weighting through those early 2000 period, then started to shift downward prior to the Great Recession. And then once that Great Recession took place, we actually saw a massive outperforming by equal weighting over market cap weighting. We still saw pretty good outperformance by equal weighting until we started to hit the late 2000, call it 19 period. Heading into COVID, we saw strong outperformance by market cap weighting, and then ultimately caught that recession in 2020. Equal weighting played out better. You saw that yin and yang kind of reversion back to the mean. But here we go. We're in 24, 25, and we have the biggest uh, unbalance versus equal in market cap weighting that we've seen actually over the last 3 decade period. So the question is, when will this counterbalance? Because typically markets do revert back to the mean. Right now, we're seeing a trend take place where some investors are actually taking notice of this, really underweighting to equal weight. And that's where they're putting their new dollars in place, right? We don't know exactly what will happen, but we do know that there are some folks that are losing some confidence with how overweighted the standard S&P 500 index, which is your C fund, is concentrated in just a handful of names. So if we are federal employees today watching this, which I assume a lot are, we need to take focus on how these trends have taken place. We don't just want to look at the past performance of our C fund and assume that's exactly what we're going to get over the next decade. That doesn't guarantee the same companies will drive the next 10 years. We also want to take a look at that industry risk. How weighted are we to tech, especially that mega tech sector, right? What could happen if earnings start to decrease or the expectations of earnings are just not what we thought they were going to be, right? Because a lot of markets price on expectation, not actually the results. So if there's any sort of slowdown in that sector, it could really hurt that. Also, keep in mind that concentration magnifies performance on the upside, but it magnifies performance on the downside, meaning that if there's a downturn to that particular 10 name sector, that could really drag that index down precipitously if we got some bad news on that sector. So timeline is another thing that I really want to kind of bring to light. If you're decades to retirement, you could probably tune out the noise, just continuing investing as you have been. If you're mid-career, you want to take notice. How much risk are you taking? How much concentration risk you have? If you're near retirement, this is when the real risk comes in because you're close to using your money. You really want to pay attention to how you're allocated. So, if we're giving you some tips today, we are going to recommend to really look at, as a TSP investor, some of your other options. The S fund, the I fund, international stocks have done very well this year. It could be the start of a trend. But if you're just looking to diversify your C fund into something similar, you can utilize the mutual fund window or another outside retirement plan that has the exposure to something that is a little bit more equal weight in the large cap space. Again, check your timeline. Also, revisit this mix, I would say yearly, to make sure that you don't have unintended consequences in your investment approach. But lastly, we as financial professionals are here to help guide you. We're here to help look inside these portfolios for you to determine how much risk you're actually taking. This is what we do for our clients on a regular basis. And if that's something that you're looking to do, we'd be more than happy to help you with that. We have a QR code for you to sign up. That QR code is right there on the left, or our website is retfed.com/register. We do give a complimentary 1 hour meeting for folks that are looking to learn a little bit more about what we do and how we help clients. And then lastly, if that's not you and you're not ready yet to do that, that's fine. Make sure you're following us on this YouTube channel, subscribe to this channel, like this video. It helps others get access to content that we're creating for federal employees just like yourself. So, again, thanks for tuning in. Until next time, hope you all have a great rest of your fall.